Trading of international currencies basically involves selling of one currency and buying another. So we can sell the domestic currency and buy the foreign currency, or we can buy the domestic currency and sell the foreign currency. And the price at which the one currency is converted into another is what we call the exchange rate. So the currencies involved in the exchange, we call them the currency pairs. So we trade them as pairs. And the price at which these pairs are bought or sold provides the exchange rate. And when the exchange rate is quoted, the name of each currency basically is abbreviated into three-letter word. We have the GBP as an example, which is an abbreviation of the Great British Pounds. We have other common pairs like the USD Japanese Yen, the USD JPY. We have Euro USD. We have USD Swiss franc, quoted as USD CHF. We have British Pound US dollar, which is GBP USD. And we have the Euro and British Pound, which is Euro GBP. So when these currencies are quoted like that as currency pairs, the first currency is usually called the base currency. So in the case of USD JPY, the USD is the base currency. And the second one, the JPY, is the counter or the quote currency. Now, the base currency is always equal to 1 unit of that currency. In other words, £1, $1, €1. So when you find the exchange rate, maybe of Euro USD, is quoted as 1.1165, that means €1 is worth $1.1165. That means the euro is having a higher price than the dollar. So when the exchange rate is described as going up, and this is where the market is now rising, this means the base currency is rising relative to the other currency, or the currency is having strength. So currency strengthening. And the vice versa, like when the exchange rate is described as going down, this is where the market is now falling. Basically, the currency is said to be weakening. So basically, we have the base currency weakening. So we usually take advantage of the rising and falling of the market. Like when we anticipate for a rising market, we usually buy. So we buy low and we close at a higher price. So we buy low, and when we close, that's where we sell. And we usually sell high when we anticipate if the market is going to fall. So we sell high and we come to close at a lower price, where when closing, we usually buy.